Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. So we just learned that Upstart is laying off 20% of its workforce. This comes after the company laid off about 7% of its staff back in November. Investors out there, you have to be wondering, is this a savvy, smart move for the company that's getting its operating statement more in line with the current environment? Or is this another nail in Upstart's coffin? This is The Smattering. I'm Jason Hall. We're going to take a closer look at what's going on with Upstart and what the most important thing for investors to focus on is. Let's start with what happened. Upstart, like all public companies, is required to disclose to the SEC when it has material changes in its business. And in this case, when the company decided to lay off 20% of its staff, that is hugely material. So the company filed with the SEC disclosing that it was going to reduce its current workforce by about 20%. That's about 365 employees. It's going to take some costs on the front side, maybe $15 million. It's going to get some benefits in the front side, but over the long run, on the back end of this, the idea is this is going to save the company about $57 million in cash savings on an annual basis. Okay. So that's the goal here. You're saving cost. You're trying to preserve cash. That really matters for Upstart right now because over the past 4 quarters, Upstart has burned through more than $430 million in cash to support its operations. It has to do some right sizing. The reality is that as the market has turned, as the economy has weakened, its lending partners have paused or backed off from using its platform to originate loans. What's happened is banks are having to circle their wagons. The reality is that these unsecured personal loans that are kind of the bread and butter of its platform are also the riskiest loans out there. We don't have a track record of Upstart's loans through economic downturns to really measure the quality of the product. And that brings me to the most important thing. Yes, the company needs to cut costs. It needs to preserve cash. It needs to make sure it can get through this downturn before the cycle turns back to positive economic data, where the banks are going to start looking at lending on its platform again when it's a safer economic environment. The big thing, what we learn about its products through this downturn is going to be immeasurably important to Upstart's future. That's not true. We're going to be able to very clearly measure the value of it. If the accuracy of its credit determinations proves to be better than things like FICO, that is going to be a massive win for Upstart. All of those lending partners are going to flood back to its platform because they know it can help them make more money. If that works out, Upstart's going to be a huge winning investment. The move that they made now only helps delay the need to raise more capital before it gets to that point. The big takeaway, makes sense that they did what they did, but this doesn't really prove out anything about Upstart. We're only going to learn that with more data based on how its loans that it issued years ago perform over an economic downturn.